We all have life advice thrown our way on a daily basis. Sometimes it's helpful advice from people we trust, and sometimes it's not so helpful or even harmful advice from well-meaning friends and family. And unfortunately, the same is true for investing advice. There are a lot of investment myths out there that could potentially stop you from building wealth and the life you desire. But you can't allow misunderstandings to deny you your financial future. So today, we will be looking at exactly what those myths are and busting them right open. Grab a pen and paper because this is one you don't want to miss. Number 1. You can time the market. One of the most enduring myths about investing is that you can time the market. Far too many people believe that they can predict when the stock market will go up or down and then buy or sell accordingly. However, the reality is that timing the market is incredibly difficult even for professional investors. Studies have shown that very few people can consistently beat the market over the long term. One of the reasons why timing the market is so difficult is because there are so many factors that can affect stock price. Interest rates, economic indicators, company earnings, and global events can all cause the market to move in unpredictable ways. As a result, for the average investor, trying to time the market is often little more than a guessing game. While there may be occasional periods where timing the market works out, it's generally not a good idea to try and predict the future movements of the stock market. Instead of trying to time the market, focus on finding good investments and holding them for the long term. Over time, the market will go up and down, but if you have a well-diversified portfolio, you'll be able to weather the ups and downs and come out ahead in the long run. So don't waste your time trying to time the market. It's a fruitless endeavor. Focus on finding quality investments and holding them for the long haul. Number 2, investing is too risky. You've probably heard the saying, there's no such thing as a free lunch. Well, that applies to investing too. If you want to earn a higher return on your investment, you have to be willing to accept more risk. Unfortunately, many people believe that investing is too risky and they miss out on the opportunity to grow their wealth. Here's the thing, all investments carry some risk. Even cash in a savings account is at risk of inflation. But if you don't take any risks, you're unlikely to achieve your financial goals. The key is to find an investment that aligns with your risk tolerance. For example, if you can't stomach the thought of losing any money, then you might want to invest in a low-risk option like bonds. On the other hand, if you're willing to take on more risk for the chance of higher returns, then stocks might be a better choice. Investing doesn't have to be complicated or scary. By understanding your risk tolerance and the different types of investments available, you can make smart choices to help you reach your financial goals. Number 3, it's a quick way to make money. One of the most common investing myths is that it's a quick way to make money. This couldn't be further from the truth. In reality, investing is a long-term proposition, and it takes time and patience to see real results. Those who are looking for a get-rich-quick scheme are likely to be disappointed. Of course, there are always exceptions to the rule. Some lucky investors do strike it rich relatively quickly. However, these cases are usually the result of pure luck rather than any brilliant investing strategy. For the vast majority of investors, slow and steady growth is the key to success. So if you're thinking about investing, don't be fooled by this myth. Yes, investing can be a great way to grow your wealth over time, but it's certainly not a quick or easy process. Be prepared to wait patiently for your investments to pay off, and you'll be more likely to achieve your long-term financial goals. Number 4, you need to pay off all your debt before you start investing. Next to owning a home versus renting, the debate between paying down debt and investing is one of the hottest themes in personal finance. While it's critical to have a solid financial foundation before investing, that doesn't mean you have to pay off all your debts before jumping into making smart investments. Before investing beyond your employer's 401k match, you should pay off your sprint debt, which is high-interest debt like credit cards. But you can't afford to wait until your marathon debt like mortgages or student loans are paid off to start investing. Years of compounding growth would be lost, which could be extremely difficult to make up as you get older. Understanding your budget and allocating spending towards both financial goals is the key. Number 5, investing is like casino gambling. Like any good myth, there is a grain of truth to the idea that investing is like casino gambling. Both activities involve some degree of risk and potential for loss, and both can be quite exciting. However, that's where the similarities end. When you invest in a company, you're buying a piece of that company and becoming a shareholder. You're not betting on the company's success or failure, you're investing in it for the long term. Over time, most companies will continue to grow and become more profitable. That means that as a shareholder, your investment is likely to increase in value as well. Of course, there's always some element of risk involved in investing, but that's why it's important to do your research and choose investments that fit your risk tolerance. With a little knowledge and care, you can stack the odds in your favor. Casino gambling, on the other hand, is a zero-sum game, and there's no way to win in the long run. The house always has the edge, and eventually you're going to lose your money. So don't let the naysayers convince you that investing is a sucker's game. It's not. Number 6, it's impossible to make money in the stock market. This is one of the most enduring myths about investing, and it's simply not true. Sure, there are periods of time when the stock market goes down, but over the long term it has always gone up. In fact, since 1928, the stock market has averaged an annual return of about 10%. Of course, there's no guarantee that you'll make money in the stock market, but if you're patient and invest for the long term, you have a good chance of success. So don't be discouraged by short-term setbacks. They're normal, and they don't mean that you can't make money in the stock market. Number 7, investing is only for the rich. One of the most persistent investing myths is that only the rich can afford to invest in stocks. This couldn't be further from the truth. In recent years, there's been a democratization of investing thanks to the advent of online brokerages and no-feed trading platforms. Now, anyone with a few $100s to spare can start investing in stocks. And there's no reason why only the wealthy should reap the benefits of stock market growth. So if you're looking to get started in investing, don't let this myth hold you back. There's never been a better time to start than now. There you have it, 7 myths that shouldn't stop you from investing. Investing is a step into the future, a better financial future at that. If you like this video and want to know more about financial independence and how to build a future, be sure to subscribe and let us know in the comments. Until next time, happy investing!